Right, hello and welcome back. So this is actually going to be my third attempt to making this video. I tried a couple of days ago to do a video on Jack in the Box, and where I was still in the height of my cold, honestly, I just could not think straight at all. Every video that I made, every attempt that I did, it just ended up waffling on over nothing because my brain during that cold was just not capable of putting a functioning level of conversation together at all. I just kept getting lost. So here we are, third attempt now, and we're going to talk about Jack in the Box. I've already gone through this in quite some detail during my lunch breaks and things like that, and obviously we're going to start off like we normally do. I'm going to try and do it in a coherent way, just to again try and get some cohesion in the way these videos are going to go. So I have already ran quite a considerable conversation through with ChatGPT about this. I've got all the data already in this one here because I've got two spreadsheets, so I'll just make sure it's the right one. So yeah, I've got all the data already in, ready to go. So for those of you that don't know, Jack in the Box is a sort of fast food restaurant. I think it's a franchise type restaurant in America. They actually own Jack in the Box, and they acquired Del Taco in 2022. So they've got a mixture of company-owned restaurants and franchise operating restaurants. Revenues derived from both direct restaurant sales plus royalties, rents, fees, etc. from the franchises. Strategy has included refranchising, shifting some company-operated stores into franchise operations to reduce capital burden, increase asset-light operations. So for those, obviously, anybody who would potentially be watching this in America, you're probably going to know exactly who they are. I had heard of Jack in the Box, despite having never been to America. I had heard of them because I've seen their adverts and stuff on like NFL adverts and all that. But Del Taco that they own, the only time I'd ever heard of it was mentioned on The Big Bang Theory, so I didn't really know what that was. It's certainly a smaller part of the business than the Jack in the Box. Jack in the Box is the core. There you go, it says there, like the core brand. Yeah, from most recent public available data, here's how the revenue is broken out by segment and type. So Jack in the Box, Q1, 133 million, and Del Taco, half of that, around about half of that. So, like I said, Jack in the Box definitely the core brand. Revenue for Jack in the Box, fiscal year 2024, 709 million. What else have we got? What else can we just briefly touch on? So, pardon me, Del Taco was acquired in 2022 and had 594 restaurants across 17 states. I got a funny feeling Jack in the Box is majoritively in a certain number of states. 21 US states plus a small number outside. Guam, recently Mexico. Jack in the Box is 2,191 stores, and Del Taco 594 restaurants as of September 2024. That was Jack in the Box has been suffering in both Jack in the Box and Del Taco with same store declines, like footfalls fall in. I have read outside of this that apparently their menu has been a bit frowned upon. People don't really like the menu that they've got at the moment. So they've been trying to sort some things out, and we're going to get into that. Refranchising, converting some company-owned stores into franchises to reduce capital expenditures, improve margins, and make it asset-light model. Del Taco especially is becoming more franchised, nearly 8% franchise as of late 2024. they're being squeezed on, their labour, commodity, packaging, utilities, unit growth. Jack in the Box is opening new restaurants in certain new markets. Now we'll get into that as well because they're also closing some. So Jack in the Box, let's pull it up here. They have got, let's just make sure I've got the SEC filing up. Actually, let's do that first. B&G Foods are on there, so that's not correct. So what should we do? 10. Let's get a 10 up. Not as prepared as I thought I was. Look, documents. Here we go. So this is the 10Q because this is the 10K, last year's 10K. So because it's the only place I can really find a lot of detail on their debt. Now, this here is obviously quite a lot written in this. If we go on to the balance sheet, 36 million in long-term debt coming due. This was in the next 12 months. 162 million in operating leases. So if we bring up this, simple free cash flow, we're just going to jump a little bit forward a minute so you can see the problem. Simple free cash flows around 40 million, interest expenses around 80 million. So they've definitely got some problems here. But I got this here. I copied and pasted this into ChatGPT and just said, look, break this down for me into more simple terms. This is something I actually really like ChatGPT for, in that a lot of this stuff, especially if you're a newer investor as I am, can seem a bit confusing. A lot of the debt talk, especially when they've got several different different subsections to talk over. They've also they've got only 35 million coming due this year, 36 million coming due this year, but then next year it's almost 300 million, and the year after that it's $500 million. And obviously with simple free cash flow this year, it was negative the previous year, but simple free cash flow this year is only 40 million. It's not a good place to be in. So the big picture was Jack in the Box needed more cash to refinance old debt and fund its acquisition of Del Taco. To do this, it raised money by selling secured notes. So this is something that I came across, which I find quite interesting because I hadn't really heard about this before, although it does make sense, is that Jack in the Box has got a negative tangible book value, like severely negative tangible book value. So the idea that they'd actually have any assets left to secure their debts is, it's not something that they're clearly going to be able to do. So what they do is that they back their debt with their franchise agreements and say like revenues and all that from certain restaurants. So if they were to default, then they would basically give up revenues on certain restaurants and all that to satisfy the debt. So they raised in 2022, they raised around 1.1 billion in two chunks. Interest rates aren't too bad on that, I don't believe. You see a lot higher interest rates. You'll see some lower ones, but you'll see a lot higher interest rates than that knocking around at the moment. So they used 570 million to pay off old notes, plus penalties and fees. So that's refinancing of old debt, and then they also used the rest of it to buy Del Taco. So that was the 2022 notes. They've also got some credit facilities, and they've got 94 million. This is going to be important. This bit here, 94.5 million left on their revolving line of credit. Yeah, talking here, the notes are backed by their revenue-generating assets, including franchise agreements, some company-owned restaurants, trademarks, and intellectual property. So it's not like the debt, most of the debt that I've come across in my experience so far, in that it's a lot of it, normally would be asset backed, in that you're going to lose this property or something, if you default on your debt. A lot of this is like you're going to lose royalty fees, you're going to lose revenues and stuff. This is what I gather from this, which I said was quite interesting, in that I'd not come across debt guarantees like that before. So they paid off 150 million Del Taco's debt. It sounds like they got a bridge loan as well, backed up by financing in case the securitization didn't go through. They never used it, but paid 2.1 million in fees. So I don't know if that's still there. It could be gone. Not entirely sure on that one, I got to be honest. So, as you can see, the old notes actually carried, this is what I'm saying, like you'll see higher interest rates. So the interest rates aren't too bad, because the old 2019 notes had higher interest rates than what they've actually refinanced for. So I've said, like, they don't appear to have a positive book value for 10 years. How have they survived this long with such a bad balance sheet? Because to me, I don't like stuff that is negative. Negative book value, I don't like it. I got to be honest, I don't like it, but I can overlook it, providing the tangible book value is all right. But when your tangible book value is literally, what is it, negative $63, for me, like it's an instant turn off. Just on the premise that should shit hit the fan, you don't have anything to dig yourself out of that with. ChatGPT has obviously gone on to explain why they've been able to, why people were willing to overlook it. So basically, they're positive because they've been able to generate positive free cash flow. A lot of people have been willing to overlook the fact that the balance sheet doesn't look so great. There you go, there, the balance sheet looks thin, not much asset value, but the income statement and the cash flow remain strong. They've been quite aggressive with share buybacks, apparently. Look, just to make sure that is the case, say aggressive. I guess they have 10 million, 30%. So yeah, reasonably aggressive with share buybacks, which is obviously another reason why people will be more interested in overlooking the fact that you've got a bad balance sheet. Leverage and securitization structure is funded largely through secured debt, not equity. Debt's backed by franchise agreements, which obviously we've already covered. Even with the negative book value, Jack has positive EBITDA, operating income and free cash flow for most years. Intangibles and brand value not fully on the balance sheet according to ChatGPT. Bottom line is that they run an asset-light, franchise-driven model that produces steady cash flows, uses debt financing, scored by predictable royalty streams, not by book equity. It's intentionally reduced equity through buybacks, which make book value look a lot worse than the underlying business health. Now, all this could be true, but obviously with this debt coming up, all of a sudden it actually becomes a problem. It says here, like, the creditors and investors care more about the cash flow coverage, not the balance sheet, which is great until the debt's coming due, which is, where they're finding themselves. So I said, like, do they own or lease most of their properties? So the majority of the restaurants are franchised and not company operated. Jack and its subsidiaries lease most of their restaurant properties, both for company operated and franchise restaurants. They only own a minority of sites, land or buildings. In this case, Jack leases a property, then franchises a store. They sublease to the franchisee and collect rent as part of the payment. So obviously the leasing keeps most of the capital costs with the franchisee and not with them. So it allows them to keep a light balance sheet and so-called allows for faster expansion. So their strategy has been to minimise own real estate and rely on leases. Jack in the Box is 93% franchised and Jack Del Taco is 80% franchised. So do you want me to dig in the exact number of owned versus leased sites? So I said here, there you go, 2,191 restaurants, 93% franchises, and Del Taco 78, so around 80%, like we said, we just covered that. only a small fraction of their total restaurants are company owned. Jack owns land and buildings for some of it, but company restaurants, possibly some restaurant sites that they then lease out. So I said, what is guaranteeing their debt if you don't really own anything? Not having any assets and falling cash flow surely makes the lenders far more sceptical about the ability to repay. And so, like we said, the debt they've secured with royalty streams, rents, it's quite interesting to know why people were thousands of franchisees paying rent and royalties every week equals reliable recurring revenue, which is why lenders are willing to overlook the fact that they don't really own anything. The leverage trade-off cash flows are softened in recent quarters. That makes debt riskier, but as long as system-wide sales remain large enough, royalties and rent are still very profitable. Negative book value mostly reflects buybacks and lease accounting, not insolvency. So as long as they stay intact, the balance sheet optics matter less. So Jack in the Box doesn't need to own hard assets to secure debt. Like we said, we've covered that. So I still think it seems like a problem. So I basically just, confirms should they fail to repay the debt, repay the debt, will they just take like X amount of revenues from the restaurants? And effectively, I'm guessing that is what is going to happen. So as I've shown you, they've only got 40 million in free cash flow, TTM this is, around 80 million in interest expense. Now, if we look at the balance sheet, where are we? Just here. We've only got 38 million in cash and equivalents. Now, that doesn't bode very well because they're actually short on just the interest expense alone. That's before they've got to pay, for other things as well. But because they've got this 96 million available line of credit on the revolver, they're basically good, at least for the next 12 months. But it does, you are starting to look at hoping that everything else, that things turn around. So ChatGPT's just broke this down here. Generate around 158 million in operating cash flows, but after paying for capital expenditures, the free cash flow is substantially lower. Leaves margin to cover interest plus debt principal, corporate overhead, and other liabilities. Their interest expense is very large relative to their free cash flow, which is a big problem for me generally. Does not easily cover interest payments. The cushion provided by cash on hand is helpful, but not huge relative to interest obligations, because unless they're paying down that debt, their interest expense isn't going to drop markedly. If we look at what the average interest expense over the last, since they bought Del Taco, is around, over 80 million. So we can estimate it's going to be very similar next year as well. So the risk factors, obviously, low free cash flow relative to interest, revenue same-store sales are dropping, free cash flow has fallen, debt servicing becomes riskier. So they've basically come out of a plan where they're going to close 200 stores over the course of the next 2 years on what they say is their underperforming stores. But if you work it out and say that with current lease expense of 159 million, so that's around about 73,000 per store, closing 200 stores would only save them around 14 million. It's not a huge amount of money saved, so 40 million in free cash flow. They're still expecting, I believe, slightly declining revenues. Margins are still going to be depressed, and then they've got to be able to pay back the interest expense, and then next year have the 400 million in debt coming due. So 14 million is not enough to move any marker effectively on how they're going to sort their shit out long term. There you go. So it barely moves the needle. 8 million annual interest expense, only about 18% coverage just by shutting them. Obviously, they will have free cash flow on top of that, presumably. But yeah, it's not a huge move, and they were as well, which I think was ludicrous. They have stopped it now. They were paying dividends all this time, even though they knew they were in trouble. They were paying dividends. And obviously that is from the cash, that has to come out from the cash that's left over. And I just thought that was a ludicrous move when I seen that they were doing that. To have the problems that they were having, high interest expense relative to free cash flow, because the year before that free cash flow was negative, minus 46 million. Only 40 million this year, but that's still an 80 million swing, so it's definitely a sign of a turnaround. But to be continuing paying a dividend when you knew that the underlying of the business was going quite south, I think is ridiculous. They have now stopped it, but that was coming out of cash that they had left, as opposed to actually having the cash to be able to do it. So the bigger story is whether or not they're closing the money losing units, because apparently they're not all money losing units. They will be underperforming stores as well. So it doesn't mean that they're actually money losing stores. It just means that they're potentially not earning as much as what Jack in the Box thought. Sorry, I'm still suffering a bit of this cold. Focus on stronger stores can stabilize cash flows and prevent further erosion. So this is what I said. I said that they're still paying a dividend, or they were still paying a dividend compared to free cash flow. Why would they do this when they purely can't afford it? Well, apparently, and I think this is quite stupid, is the only reason that they would do that is because when you stop paying a dividend, obviously it does not look very good. It's almost an admittance to the market that you are having problems, and then a lot of people will actually dive out, and it will obviously cause the stock to tank even further. Now, yeah, all right, that's not what you want, but surely actually trying to figure out and trying to stop the rot in the underlying business is more important than what you'd hope is a temporary drop in share price. So to me, I don't really subscribe to that line of thinking in that, oh no, we've got to keep paying it, even though we can't afford it, we've got to keep paying it, because otherwise it makes us look bad to the shareholders. Like, I think, well, my opinion is your fucking number one priority is get your fucking ducks in a row and make sure that the company's doing all right, So that's just me. But yeah, it's taken them a lot longer to stop the dividend than they should have done. That was like 36 million. So if they were making 40 million free cash flow, they had 80 million interest expense to pay, and they were still paying 36 million in a dividend. To me, that's just ludicrous. It just stinks of bad management, when free cash flow barely covers interest. Paying dividends weakens balance sheet further. Obviously, that's obvious. To me, that's just not good management. Basically, I don't know. Maybe they were scared to do what needed to be done. I don't know. Jack in the Box keeping the dividend, most likely signaling for signaling and shareholder appeasement, but not because they're flush with cash. And I said, just to me, bad idea. They have stopped it now, though. So we'll move past this section, because this was just like me, shooting some stuff out, basically saying that closing those stores wouldn't even cover half the dividends. 36 million on dividends, and then you'd save like 40 million by closing stores. That getting rid of dividends had to be a big thing, because you couldn't afford it. So they have now made that decision, which is obviously going to be better for the underlying financials. I said that for a company that majority leases properties, $1 billion in buildings seems very high. So if we go to, where are we? Goodwill and intangible assets. Is this it? Oop. Oh, it might actually be on the balance sheet of this one. There you go. Around about $1 billion in buildings that they own, but they only own 94 million in land. So what I have found out, which I found quite interesting as well, is that if a company's balance sheet here, their the land that they own is significantly less than the buildings that they own, then that supposedly suggests that almost all of these buildings are either right of use assets or buildings that they own are on leased land now. So it's all very well saying we've got, $1 billion in buildings which could be used, you'd assume could be used as collateral for debt. Actually, a lot of that is worthless, because if you don't own the land underneath it, nobody's going to be overly willing to buy it. So, for looking at it thinking, oh yeah, they've got $1 billion in buildings that could help satisfy debt, it's not actually the case. I think I run this through. I think I run this through with ChatGPT actually, because I was trying to get my head around that. Land is 10 times higher than building. What does this mean in terms of what they own? So, if land is 10 times higher than, not 10 times higher, it's 10 times lower. Sorry, I made a mistake there. If land is 10 times smaller than buildings, here's what it implies. So it requires capitalising operating leases and buildings, right of use assets on the balance sheet. So the majority of buildings aren't actually owned. Their lease properties accounted for as asset. Land is much smaller because Jack owns very little land outright, mostly just a few corporate operated locations and strategically important places. So, like I said, none of this is actually any good at all. So with regards to satisfying debts, if they default within the buildings, they are actually almost worthless. Effectively, they can't guarantee them as their debt, because nobody's going to want to say they did own them but it was on leased land. Nobody's going to want to buy it if they can't own the land as well. In a default, lenders can't seize buildings because most are leased. That would instead take control of the cash. So obviously that's why they've had to go down the route of guaranteeing royalties from cash flows and leases and stuff like that. The buildings on the balance sheet are mostly accounting entries. True collateral for debt is primarily intangible. Lenders are betting on ongoing cash flow from franchise system, not physical property to recover. So where did we go after that? So as I said, under the model, this model, property is virtually useless. Exactly, under Jack-in-the-Box model, physical property is almost worthless as collateral for debt in most cases. So that doesn't help. So I said, if Jack is only making 40 million free cash flow, 38 million in cash, but 80 million in interest expenses, was paying a dividend, closing stores won't contribute a lot. I know they have a credit facility they can draw on to help them through the next 12 months, but if they don't improve in the following 12 months, they could be in serious trouble. So, closing the 200 stores saves 40 million in lease expense. Obviously, it will save running costs of these stores. How much is that likely to be on average? Do you take operating costs? So this is my way of thinking then. Obviously, this is just me learning and then trying to figure out what costs you would save by closing these stores. So I think we ran through some figures down here. We know we're going to save 40 million in leases from these stores. Where do we go next? Let's just see. So SG&A expenses were around 143 million. Operating expenses were around 190 million. So that's around 87,000 per store in operating expense. And where are we going? So 40 million lease expense a year. Operating costs of this. So this is for the stores that they're closing. If they're going to close 200 stores, on average, the operating costs is about 17 million per store, 13 million per SG&A, and the lease would have been saving about 14.6 million, so 45.1 million, roughly 45 million per year can be saved by closing 200 corporate operated stores. So that's the lease, the operating costs, and the allocated SG&A. So that does make things slightly better. If you could potentially add 45 million more cash on top by closing these stores. So it seems like they are going in the right direction. it's still not something that I'm, overly convinced by. 45 million in savings from closing these stores on the high end, assuming all stores are Jack owned that close. Free cash flow of 44 million, considering footfall has dropped. Could they just about break an actual cash flow profit? With the lease expense, obviously 80 million lease expense, but 40 million free cash flow currently, you're potentially saving 45 million by shutting these stores. It's starting to go in the right direction at that point, but they're still not going to have enough money to find, to pay the 550 million by 2027. I think that there are tougher times ahead for Jack. I think that obviously with the revolver they can get through the next year. I don't think there's got a problem, but then they've basically got to get their ass in gear quite quickly in order to proceed and turn the business around after that, because there's only so much they can take on the revolver. There's only turning around a business is not going to happen overnight. Effectively 24 months is a decent amount of time to do it. So store closures, dividend suspension, it could allow Jack to just barely cash flow positive in the short term, but structural debt, weak collateral, declining sales mean the company is still in a precarious financial position. Any sustained downturn or misstep could push them into default or forced restructuring before 2027. So, this is when I realised that Jack had suspended the dividend. I should have realised that earlier on, to be honest, but they had suspended the dividend. So they're going to save what was it, 28 million a year or something by not paying a dividend, which is obviously now cash that should go on the balance sheet, but it's obviously going to have to go towards other things. So they said suspending a dividend doesn't magically create cash, it only stops planned outflow, because obviously the dividend's paid from the cash that was left at the end. So basically all they're saying is we're going to keep more cash on the books afterwards, which is what is needed for them. Stopping a dividend is helpful but insufficient measure by itself. The true improvement requires cash flow, same-store sales recoveries, cost savings. Without these operational changes, Jack can't sustainably cover interest and principal obligations. So they bought Del Taco in 2022 and they're already looking to offload it. I said, why buy it and sell it so quickly? That just seems like incredibly bad management. Acquiring the company and then divesting it just a few years later can indeed, sorry, my phone just went off, could indeed raise concerns about strategic consistency and management execution. Del Taco experienced 3.6% decline in same-store sales in Q2, with a notable drop in restaurant-level margins due to rising commodity prices and wage inflation. Jack in the Box aims to streamline its operations and reduce debt. Selling Del Taco would allow the company to focus more on its core. So they bought it for 585. They bought it for 585 million. Assumingly, they'd want to sell it for something reasonably close. So if we were to look at total debt, what would that bring it down to? It's not a huge. Is this Jack? Yes. Taking 500 million off is not. There we are. Sorry, here. It's not. It's definitely going to be helpful, but it's not going to be amazing, is it? It's not going to be, the golden goose to try and help them. But yeah, Jack in the Box aims to streamline its operations and reduce debt. Selling Del Taco allowed the company to focus more on its core Jack in the Box brand and turnaround efforts. While the decision to sell Del Taco shortly after acquisition might raise eyebrows, it is important to consider the context. So, it's a highly competitive industry. They're saying market conditions can change rapidly. What seemed like a good acquisition in 2022 may no longer align with the company's objectives in 2025. And I guess from that point of view, post-COVID, everybody was like happy to get out again and get back into restaurants because they could. So I guess maybe there was an assumption that that would go on forever. Obviously shops and all that, retailers had a big uptick after the COVID problems, didn't they? After all the lockdowns, but it all seems to have like tailed off again, as I suppose we've got more back into our lazy ways. I don't know. So if the sale of Del Taco helps Jack in the Box reduce debt and improve its financial position, it could be seen as a prudent move to strengthen the company's balance sheet. Now, yes, I agree with that, but at the same time, it seems to me like that was a bad acquisition. If you need to buy something and then sell it almost immediately, you didn't make a good acquisition. You know, ChatGPTs are trying to be, and potentially rightfully trying to be, on the fence about it. While the decision to sell Del Taco shortly after its acquisition may raise questions about management's strategic direction, it appears to be a calculated move aimed at strengthening Jack in the Box's financial position and focusing on its core operations. Now, that would help, wouldn't it, if they could get around about what they bought it for. Roundabout. Bear in mind that they've had declines in revenues, declines in footfalls. It doesn't look as appealing as what it did when they bought it, but if they could get around about that, then obviously it would help over the next few years to pay off some of this that's coming due. You know, 300 million, 516 million. So it's something that I can see them definitely doing. I think that they, considering their free cash flow positions, it's something I can see them doing. I can see Jack in the Box getting rid of Del Taco to help satisfy some of this debt. It is the logical thing to do. I just said, like, you know, which is underperforming? Is it Jack in the Box or Del Taco or both? And it is both. Jack in the Box actually declined by 7.1% year over year. Q3 2025 that was from. Del Taco actually dropped less, but Del Taco is a smaller portion of their business. You know. So the strategic action was to close stores, cut costs and restructure, and Del Taco, they're exploring the sale to free up cash and reduce debt, which would help. We've seen that would help, you know, 300 million, 400 million, whatever it is coming due. If you could get around 500 million for it, it takes the pressure off and gives you, gives you until 2027. So instead of, we said they're going to get through 2025, 2026 is going to be an issue if things don't turn around. But if they sell Del Taco, they actually give themselves another 12 months on top of that before they're, I would say, almost certainly going to have to try and refinance the debt. But if they could go into that in 2027 with a turnaround business, they've got much more ability to do that. Both brands are underperformers, but Jack in the Box is more operationally challenged, while Del Taco is primarily a burden. So Jack on Track is what their restructuring plan's called. So I said, you know, can you break it down for me? So they plan to shut 150 to 200 underperforming stores. So basically I've done everything off the 200, which is like the money that'd be saved off the 200 closings, like 40 million in lease expense and the operational costs and the SG&A costs. So that was not on the conservative end of it. I basically should have been doing it on the 150 side of it. So things could actually be worse than what we'd talked about earlier. So they're going to close around 80 to 120 stores by the end of this year, end of this fiscal year. The rest, they're going to basically, when the franchises come to an end, they're just not going to renew them. So they expect, starting in fiscal year 2026, expect an ongoing annual closure rate of around 1%. They've immediately stopped paying the dividends and redirected that cash towards debt payoffs, leverage reduction. They intend to sell more of the properties they actually own, and not least to raise cash. Proceeds will go down towards debt pay down. So Whether or not that ended up becoming like a sale leaseback, or literally they would just get rid of some of the places, I don't know, because they don't appear to own an awful lot of their stores in the first place. So they're significantly dialed back spending on building new company-owned Jack in the Box restaurants. They're going to invest in technology to help, help the business simplify operations. Obviously, like McDonald's and all that. I don't know if Jack in the Box have. I'm assuming that they have, but whether or not it's any good, I don't know. Obviously, McDonald's and all that, you can order your food on your app beforehand and then go and give them your order number, and it's there for you. And whether that Jack in the Box do that, I don't know. But Bank of America is exploring the sale of Del Taco or other alternatives. So they haven't stated what they expect their revenue loss to be from these stores now, from these store closings, which is frustrating, but I guess it's not something that they're willing to, they're in the public domain. Some of these stores could be, to losers anyway, so it's not so bad losing money from restaurants that are actually costing you more to run than earning. They've not stated as well exactly which stores will close, whether or not they're company owned or franchised. Some will close when the franchise agreements expire. So they've provided rough guidance on margins, but the cash benefits after all taxes, taxes are somewhat opaque, so they've not really supposedly given a lot of information into what their plan is. Says that the plan is serious and does hit many of the right levers: cuts costs, reduce fixed obligations, reduce growth, spend, focus on core business, sell non-core assets, but the execution risk is high. Closing stores cost money up front, savings come over time. The revenue loss from closed stores must be replaced or offset. And then obviously you've got like the pressures on the cost of the labour, cost of food, inflation, decline in traffic still weighing heavily. So yes, the plan could allow Jack to be just about stabilise or slow its bleeding, maybe even approach break-even cash flows if it all goes well, but it's not a magical fix. If revenue continues shrinking or if closures, franchisees' transitions are messy, they could still be in serious trouble. I said, like, what margin guidance are they giving? Now, it wasn't very specific on this, I got to say. So they've just said they expect it to be 19 to 20%. Now, I'm guessing that's gross margin, because that is around in line with what... Well, it's not around in line, it's significantly less than what gross margin is, but I cannot see it. I suppose it could be operating margin when they were there, around about that level, but significantly dropped. That's another thing. The operating margin significantly dropped, free cash flow margin significantly dropped. Yeah. It's not specific. Unfortunately, ChatGPT was not specific in what margin this is. Restaurant owned level margin. I don't know what level margin is, I have to say. So earnings per share is expected to be 5 to 5.40. What is it currently? I have got it on here. Negative. So that's a significant turnaround. Should it be? That is actually also more in line with what it was historically. So, if that is what they're expecting come the end of their plan, that's not bad, is it? 19 to 21% margin target for company-owned restaurants suggests that the management believes cost pressures can be managed to some degree, but not entirely eliminated. That includes labour, utilities, commodity inflation. Earnings per share guidance, excluding the heavy part of restructuring, means that the cost savings benefits of store closures, real estate, are not fully backed into those numbers yet. So there's some upside potential if Jack on Track initiatives deliver as planned. What they haven't provided, did not explicitly guide what the overall company level margin across both Jack and Del Taco will be under the Jack on Track plan. I'm wondering whether or not that's because the Del Taco part of it is potentially not part of the Jack on Track plan if they're looking to get rid of it. They haven't disclosed how fast the margin uplift from store closures, real estate sales and cost reductions will flow into EBITDA or / free cash flow. Some of the improvements may lag. Overall, right, for me, it's very interesting to dig into whether or not, and this is why I've done it, and this is why I'm showing you that I've done it as well, basically so I can look back on it in the future as well. This is a record for me, but very interesting. I found it very interesting to look into whether or not Jack can survive. But I just think at the moment everything's way too risky, and I think to pay $18, $19 for a company that can potentially barely cover interest expense, that's when everything goes well as well. If everything goes well, I can, from everything that they're saying, I cannot see them in the next few years at least getting up to 160 million in free cash flow again. I can't see it. And if they get up to 80 million, they're still going to have around 80 million in interest expense. I just think, yes, all right, you've got 96 million on a revolving line of credit. I just think that, there's some tough times ahead for Jack. I don't think it's going to fix anything overnight. I think that what do I think? I think they get through the next 12 months based on the free cash flow, the cash that they've got, and the 96 million revolver. I think they absolutely have to sell Del Taco to get through the preceding 12 months to cover this, 300 million in maturity of the debt. So they've got 48 months to try and get to a point where they're gonna have to refinance this, which is not impossible, right? If the free cash flows and all that turn around, then yes, it is probable that they will be able to. But I do believe that it depends on having to sell Del Taco to satisfy this debt with the current free cash flows and the current interest expense. I believe that they will have to sell Del Taco. And obviously that is not a given that they're going to get a good price for it, considering they've had year-over-year declines in footfall and revenues and all that. So Jack is an interesting one to keep an eye on, and when you consider where the price has been historically, I mean, up here it seems crazy to me, trading at 20 times free cash flows, probably on average. Let's pop, see if we can, how do I do this? So where are we? We see that's a median line, yeah, around 20 times free cash flows. Yeah, it's possible, that they can get back there, but the next 12, 24 months are going to be crucial for them, and I think a lot of it hinges on the fact that they got to sell Del Taco, which is, again, ridiculous. There's Jack, I don't believe we're going to end up having to watch a bloody video here. I expect. What's going on here? Why is it taking so long to load? Have I lost the internet? No, I have not. So what is going on here? So no insider purchases, you can see. Not that we can see them all, but they're all red. Look at Mooney's Proprietary Wagons fund now. Let's see what he was holding. Jack in the Box. Any significant holders? So a couple people, 100% of their portfolio. Nobody that I really know of and semi-respect. Not really. Nobody owns, not large enough portions of their portfolio. I haven't heard of any of these. So, and if we were to look at the proxy statement to see what insider ownership is, to see if that aligns with us as a shareholder. What does that come back with? They haven't even got benefit. Oh, I spelled beneficial wrong then. That's why. Let's see. I think I have checked this out, and I don't think it's significant at all. Security of beneficial owners, 1.4%. So ownership, directors, management, 1.4%. This, you know, are their priorities significantly aligned with yours? Do they have enough skin in the game for it to matter to them? A massive amount? No. Yeah, you'd like to see more, considering the problems that Jack in the Box are facing, you know. Yeah, historically 20 times free cash flows. What would graphic calculator 80, say they got back to 80, bear in mind they still got to pay down the debt. Where are we? How many shares are outstanding currently? 19. I mean, 20 times free cash flow with a slightly delever. This is a problem. They got to delever the balance sheet in order to even consider 20 times free cash flows. And that at the moment remains to be seen. You know, the business is still going in the wrong direction, with very little assets to cover for, you know, any of it. I mean, it's not unthinkable, is it, that it could turn around? It is a reasonable sized brand. Like I said, I've heard of it on this side of the Atlantic. Currently, it would be a gamble to me. It would be a gamble if they sell Del Taco. Then I would see that as a positive sign. Believe it or not, even though I think it's ludicrous that you bought something to immediately sell it. But if talk comes out that the sale of Del Taco is going through, then I would see that as a positive thing for Jack in the Box, and then maybe I guess you could see things going higher. But for me, currently there's still too many unknowns. Falling revenues, falling footfall, the debt, the interest expense, you know. Simple free cash flow margin as well, you'd assume is going to get lower if they're saying all the margins are being squeezed. Lower revenues because you've potentially lower revenues because you shut stores. It will definitely be lower revenues if you get rid of Del Taco. You know, the 80 million. When you look at it that way, the idea that they could get back to 80 million seems very difficult. So for me, it's definitely one to watch, but one to invest in. I just think it'd be highly speculative given all the information that we've currently got. You know, not for me. So we're going to move on from Jack in the Box, but it's very interesting for me to delve into, you know, the potentials for the turnaround. And I think that's mainly why, obviously going into this video, I knew that it was not something I was going to be interested in, because I'd already done all this research. But it was, you know, with regards to vlogging my journey and, you know, maybe using it as a reference material to come back on Monday, I found it quite interesting looking into, you know, the potential savings and what could happen and what is required for Jack in the Box to turn around. And it is significant. It is going to be a hard slog. Even ChatGPT is saying, you know, like it's, you know, they could be in some serious trouble. There you go. They could still be in serious trouble. One of the last things that they said. It's interesting. I haven't actually seen what anybody else has said on Jack in the Box. I believe it'd be strong sells. There we go. Strong sell, sell, hold. Somebody said buy in March. What was the price in March? So you'd have lost 50% of your money. It's too speculative at the moment. It's too speculative. Sell Del Taco, and I would see that as a positive catalyst. But at the moment, there's only talk that they've spoke to Bank of America about the possibility of doing it. If those rumours start to become more serious, then maybe we'll have another look at Jack in the Box again. But like I said, bear in mind, they sell Del Taco, they're going to lose a lot of revenues. If the margins are being squeezed even more, then the idea that they can get back to 80 million free cash flow anytime soon, I think, is not going to happen. And selling it for maybe 500 million. I mean, they're obviously going to want more. They're going to want as much as they can get for Del Taco, but say they sold it for around 500 million, it doesn't make a huge dent in their debt, which obviously, from that perspective, it's probably not going to make a huge difference to their interest expense. So I think they're in for a problem, for a little while yet. I think the next 12 months is fine. The 12 months after that is crucial. Sell Del Taco in that time. You're going to give yourself 12 months more. It's just whether or not anybody wants to make a speculative bet this early on what potentially could be 3 years worth of turmoil before they... I mean, if anybody watches this, please give me your opinions on it. You could, I very well could be looking at this completely wrong. This is like one of my first times really delving into, one of my first experiences delving into something like this that's got these significant, issues facing it. So we'll see. We're going to leave Jack in the Box there. Now we're going to move on from that one. Might even finish the video here. I don't know. We'll see. I'm going to go to bed now, and if not, then I will see you in about 10 seconds, because obviously the video will just flick over. Or if I am going to finish the video here, then we'll see you on the next one. So I have no idea what I'm going to do. You'll know when I know. But for now, I'm going to go to bed, and I'm going to leave it at that. Jack in the Box for me, currently a no. Going to be interesting to watch. And that's where I'm going to leave it. Alright, I know I said it was finished with Jack in the Box, but I've come across this interesting article this morning actually on Value Investors Club, where this person up here has wrote up a write-up on what they believe Jack in the Box to be a reasonable deep value play. So what I've actually just done is I've run some tests, I guess, on what this article is saying. This is the June 22nd, 2025 article. Now, he's interestingly mentioned that between, where is it? Jack in the Box used to own another Mexican restaurant, Cordoba, is that how you pronounce it? Which they sold in 2018. And they bought Del Taco in 2022. So between 2018 and say 2021 is actually the most accurate way to what would you say, like estimate Jack in the Box standalone core business, because during this time 2018 to early 2022, the company was essentially a single brand operator, so it was only Jack in the Box. So if we look at Jack in the Box, let's make sure I pull up the right one. So from 2018 to say early 2021, their simple free cash flow margin was significantly higher than what it is now. Now, obviously, they've got issues that they potentially didn't have back then, but their simple free cash flow margin average over those 4 years was around about 9%, which is very, very good, actually. Now, if we say that they're going to sell Del Taco, so what did we say? They lose about 400 million in revenues from selling Del Taco, so $1 billion in revenues. And then this is just going to be off a Joel Greenblatt multiple type analysis. But that $1 billion in revenues, a simple free cash flow margin, and we're going to say 5.5. So what I've done is I've gone less than what the average was during this period. In fact, almost half of what this average was during this period of the simple free cash flow margin. Now, that would actually give a multiple of 6 on their future simple free cash flow. And if we go back to what was that, 2018 to 2021, let's get this free cash flow. What's going on here? Close that. So between 2018 and 2021, they were averaging, what we say, around 15 times multiple on simple free cash flow. So this is the price to free cash flow ratio. So yeah, 2019 to 2021, what would we say the median line is there? So maybe 13, 14 times simple free cash flow. So on a 55 million simple free cash flow, forward free cash flow value, that would suggest there is potential for undervaluation there, which is what, how do I get rid of this? I shrink that down. There we go. Get the price back up. This guy here is suggesting that he implies that the stock is a double, which on a simple free cash flow margin like that would, could not guidance at all. I'm just seeing from his logic, could back that up, I guess. The only other thing to mention is that obviously my debt levels are significantly higher, I guess, than what they actually are, because my total debt takes into account the interest expense. If we actually go on their balance sheet, the total long-term debt, interest-bearing debt, is about 1.7 billion. So say they sold Del Taco and got like 500 million for it, they'd have 1.2 billion left. Their average cost of debt, so this is just the interest expense. I don't do the weighted average cost of capital, because I think a portion of that's hoodoo, but we're talking 2%. So if we were to say be conservative and say 3%, the cost of debt is 3%, their interest expenses actually would be, post Del Taco, significantly lower. What would it cost a year? Let's just have a look. So what are we going to say? 1.2 billion times 0.03. So that'd be a 36 million interest expense a year. Now, obviously that is less than half of what it is currently, providing that the entirety of a sale of Del Taco went on cutting the debt, which is obviously not a realistic way to look at it, because they've obviously got costs and all that they want to cut anyway. But this simple free cash flow margin here, it doesn't minus interest expense, does it? Because interest expense is already accounted for. There you go. So you could end up actually being, 40 million higher on this, purely because your interest expense is cut in half. This has got interest expense factored into it already. So just reading that article, there is another side to it, where we can, even though I'm still very skeptical, you need the proof is going to be in the pudding of what they do. But this article I found very interesting, and you can, with conservative figures, make it make sense, So two sides to the coin we've seen here with Jack. I know I said that I'd moved on from it, but quick 10-minute extra, two sides of the coin to it. There is potentially another side to this trade. Now, I'm not going to make an opinion on it at all. I'm not going to recommend anything at all, ever. I don't know what I'm doing. I'm just literally, pointing out, adding on to what I said yesterday in that the proof's going to be in the pudding. They have got serious problems, but if they paid down their debt, they could cut their interest expense significantly. And if they went to, where are we here? Just based off of this, 291 simple free cash flow, 2.91 times, what would we say? Just be conservative and say 13, because I think it was 14. That would be $38 a share. But a lot has to go right in order for that to happen. I would say it's a highly speculative play, but just by reading someone else's article and having a look at some basic figures, which I believe to be semi-conservative, you are basing it off of a historic simple free cash flow margin, even though we're using much less than what they earned between 2018 to 2021, where that period was obviously the sole Jack in the Box era. So we're being conservative on that in only using 5.5% of that, but it is interesting that there is potentially another side of the coin to this. Very speculative, on the hope that everything goes right for them, though. Obviously the core business is potentially not in as good a spot as it was back then. We know there's year over year declines in revenues and footfall, and I would suggest that means that the image of the business amongst people that want to go out to restaurants at the moment is not great. But two sides to the coin on this one, in that there is something to it if everything goes right, but highly speculative, I guess, in the hope that everything does go right. But I can see some sort of upside to go along with this, but we will see. Anyway, we're going to move on from Jack now, but there we are. There's another side to that coin. Although actually I've just noticed here that they will pay down 300 million of debt. I'm not sure where they got that figure from. That's potentially in the Jack on track documentation, to be fair, as he's a successful execution of Jack on track, will pay down 300 million in debt. So if what was it, 1.7? So it'd be 1.4 times 0.03. So interest expense would still be around about halved, based on that, which is significant. On a 3%, interest expense, interest ratio, which the current one is around about 2.5. So according to ChatGPT, anyway. Interesting. Providing I'm getting that right. Am I getting that right? I don't know, because they're saying there's 3.1 billion in debt on the book now. I take it they're using operating lease in that as well, because that would make figures up closer to mine. Is that debt level using operating leases also, or just interest bearing debt? Let's just see if ChatGPT can clarify their position on that. It's only interest bearing debt. So on the balance sheet, am I being stupid here? Got Jack in the Box up here. Oh, this is a 10k mine. I am out of date. Let's have another look on the latest one. Balance sheet. Still only 1.7 in debt on the balance sheet. Long term debt on the most recent balance sheet shows only 1.7 billion. Long-term debt 1.7, add current maturities of long-term, yeah, okay, I get that. They're including lease liabilities, that's exactly what I said, and you said no. Interest expense only applies to that, yeah, so. Right, so the actual, interest-bearing debt is only around 1.7. So if you took 300 million away from the interest-bearing debt, then yes, the figures would add up. So that's where we are. But yeah, what I think I'm going to do is I'm going to leave this as a standalone Jack in the Box video, I think, just so I can get something up. It's been a few days since I've actually got a video up, and I don't really like that, but I think I'm going to be quite busy over the next few days, and I want to get this video finished, really. So yeah, as I said, two sides to the coin. Potential for upside, speculative potential for upside. Everything has to go right. Or on the flip side, they're in for a hard slog. Like we said, they could have another, 24 months of a hard slog. I guess you're gonna have to make up your own mind on that. But interesting. It is interesting when you try and read opposing views to your own. Because my view, obviously, from the first hour of the video was that it's going to be difficult for them to turn it around, and then you read this and you run some figures, and you can see another view to it. Maybe certainly worth looking into more of this side of it if, there is a potential for a 100% upside long term, but that's certainly not my my recommendation. I'm literally just on my educational journey reading someone else and see whether or not I can get the figures to match with this. There are comments on it. Why aren't you deducting interest expense and taxes to arrive at free cash flow? Yeah, his free cash flow figures are very high. Anyway, I'm going to go away and read this bit. Like I said, Jack in the Box Inc. June 2022, 2025 is the article if you want to go and read some of it yourself. I am going to leave this video here, and I will see you on the next one. Thank you very much. Like and subscribe, and hopefully there wasn't a lot of waffle in this video, but if you're not interested in finance, there was probably a lot of waffle in this video. Anyway, take it easy. See you on the next one.